This is the mini lecture for Unit 6, Accounting for General Long-Term Liabilities and Debt Service. Like the last unit where we talked about general capital assets, those that are related to the governmental activities, that's what we're talking about here as well. After the midterm, we will look at proprietary activities, enterprise funds, internal service funds, and proprietary and fiduciary funds, both of which are accounted for on an accrual basis. Proprietary funds are accounted for on an accrual basis in the fund financial statements and as business type activities in the government-wide statements. So these chapters last week and this week were important in part because you need to see the different manner in which the accounting is done under modified accrual in the governmental funds. Long-term liabilities in general, just to make sure everyone understands that we're talking about liabilities with maturities of greater than a year, so they're going to come due beyond 1 year. So we're talking about outstanding bonds, general obligation bonds, revenue bonds, special assessment bonds, notes, capital leases, compensated absences, which are accumulated paid leave time for the government's employees, judgments and claims. Claims being like, if a government is self-insuring or insuring some other activity, those are claims for payment. Judgments, meaning legal cases where the government is facing a monetary punishment. Things to keep in mind, as with the capital assets, you have to remember that even though long-term liabilities aren't reported in the in the governmental funds, that doesn't mean that long-term liability transactions aren't reflected in the governmental funds. They are, because they involve flows of current financial resources. And anything that involves a flow of current financial resources is going to be reflected in the governmental fund financial statements, even though you don't see capital assets there, you don't see long-term liabilities there. So, for instance, if government issues long-term bonds, then there is an inflow of current financial resources in the form of the bond proceeds. And those are, you're going to debit cash, and you're going to credit an other financing source, bond proceeds. Likewise, when you're repaying the debt, there is an outflow of current financial resources. You're going to debit interest expenditure, you're going to debit principal expenditure, and you're going to credit cash. You want to make sure you understand the note disclosures. There's one really big important one for long-term liabilities, similar to the disclosure for changes in capital assets. This is changes in long-term liabilities during the period covered by the financial statements. So you start in the left-hand side with the beginning balance. You add new liabilities, new debt that's been issued, new compensated absences that were incurred. Then you subtract payments against those debts, other forms of satisfaction of those liabilities. For instance, an employee retires or otherwise leaves the employer, the government, and cashes in his or her compensated absences. That would reduce the outstanding balance. And then on the right-hand side, you have the ending balance, which should total to an amount that's consistent with what you see in the statement of net position, the government-wide statement of net position. And then on the far right-hand side, there is a column that shows the portion of those long-term liabilities that are due within the next year. You will see in this note disclosure that governmental activities and business type activities are shown separately, and liabilities are shown by type. So you will see bonds separate from leases, separate from compensated absence, judgments and claims, pollution remediation obligations, and so on and so forth. Another important note disclosure relating to long-term liabilities is the minimum debt service schedule, which shows the debt service payments going forward until all of the outstanding debt has been fully paid off. And you see that in separate interest and principal components for each of the next 5 years individually. So if this is fiscal year 2014, you're going to see 2015, 16, 17, 18, and 19 individually, and then from that point forward you see it in 5-year increments. So 2020 to 2024, 2025 to 2029, and so on until the debt is fully paid off. If you're looking at variable rate debt, that's debt where the interest rate changes depending upon some market index, then the calculation of the debt service payments going forward is based upon whatever that rate was as of the date of the financial statements, and the note also should indicate the terms under which the rates change, how often they change, and what they're based on. There, you will also see a very similar schedule for minimum lease payments if a government has capital leases. There are a couple of very useful statistical section schedules that you should be familiar with. One is the outstanding debt limit or outstanding debt margin schedule. Most governments have some kind of legal or constitutional limit on how much they can borrow. It's often calculated as a percentage of property value, because for a lot of governments, their primary revenue source is the property tax. That's what they're securing their general obligation debt with, and that's what they're repaying it with. So it's often calculated as maybe 3% of total assessed value. You can't have any more outstanding debt than that. And what the schedule does is it calculates what that debt limit is, and then compares it to the amount of outstanding debt they have, which gives you the debt margin, the difference between the maximum they're allowed to have outstanding and how much they have outstanding as of the date of the financial statements. So that gives you a sense of how much room they have for additional borrowing. The other schedule in the statistical section that's really valuable is the overlapping debt schedule. It's a fact that you as a taxpayer live in multiple governments. You live in a state, probably a county, a city, a school district, maybe some special districts like a water district or a fire district, and each of those may have outstanding debt of its own. Each of which you are responsible for paying a part through your tax payments. And so the overlapping debt schedule is meant to give you a sense of, for the residents of this particular reporting government, what's the overall debt burden that those taxpayers are bearing or that economy is bearing, even if that particular reporting government isn't legally responsible for that debt. And so by overlapping debt, what we mean is the debt of any government that overlaps geographically in part or in total with the reporting government. And if a government is fully encompassed within the reporting government, say the reporting government's a county and you've got a city within it, then this schedule is going to include all of that city's debt. But let's say it covers. You're looking at a city and there's a school district in it that is split between that city and another city. Let's say it's 50-50 to make it easy to understand. So looking at what you'd include in that city's overlapping debt schedule, you'd include 50% of the relevant debt in that from that school district. You want to make sure you know all the debits and credits for the major long-term liability transactions, both under accrual and modified accrual, for the issuance of debt, the repayment of debt, special assessments. Particularly, we're talking here about special assessments for which there is some government involvement. And what I mean by that is, for special assessments where there is no government involvement, no responsibility on the part of the government to ever have to repay any of that debt. The government essentially just is a facilitator of the borrowing. Then they don't report a liability because they're not on the hook for any of that debt, but they do make some note disclosures about it. So we're talking about debt that the government might be, may be responsible for paying some, or for stepping in and backstopping it if the special assessment doesn't raise a sufficient amount of revenue to pay the debt service in a given year. You want to look at those transactions, the lease payment transactions, and the debits and credits for debt refundings as well.